Now, if you invest in the stock market, one way to help manage risk, it's called diversification of a portfolio. The simplest explanation of that, not putting all your eggs in one basket. The Wall Street Journal said that a well-diversified portfolio can lower risk and volatility and offer more consistent returns. So some pros, a lot of upside, and we all know the adage of not putting your eggs in one basket. Are there any cons of diversifying a portfolio? And with those in mind, is it still worth it? And how often should you actually diversify?
I think there's definitely pros and cons of diversifying your portfolio. It can be used in good terms, and it can be used to diminish your returns as well. I use the context, if you look at the world of investing, you have large, medium, small, international stocks and bonds. And then what happens is a lot of investment approaches are designed to put a little bit of money into each of those categories. Give you a perfect example. If you have like a target date retirement account, as you get closer to that target date or your retirement date, what happens is, they're going to allocate more money to the fixed income environment. They're going to reduce equity exposure. And if we look at the past couple of years, what happened is you had a lot of these people that were getting close to retirement time, and they were moving money into decade level low fixed income environment. And so, as we know, usually when interest rates go up, bond prices go down. And as interest rates skyrocketed, these people that were getting close to retirement time, thought they were diversifying, and they were getting put into a terrible asset class that had little to no opportunity with where interest rates were, and they really got clobbered over the last couple of years. I almost look at it in terms of like shooting a shotgun, right? It's like going out back and blasting off a shotgun and hopefully you hit something. Now, I served in the United States Marine Corps, and when I was in the Marine Corps, you either hit your target or you missed. It's either bullseye or nothing. So in thinking of terms of diversification, yes, I think there are things that are important out there, but what I would recommend that folks do is to take a sniper shot approach at identifying what do they want to have inside of their portfolio. I also see a lot of people who own variable annuities as another example. And in a lot of these variable annuities, they will just traditionally put people into an asset allocation model. And again, the thought process is hopefully more goes up than down and you make money. That to me is not the proper use of diversification. When we look at diversification, what we do is we look at it based upon time frames and what the intent is of the portfolio. And this process is known as the independent income system. And so within the independent income system, what we want to do is we want to have a bucket of money that's designed for reliable income. Well, there's certain investments that are designed to generate income that can be part of the plan. Just the same as you want to have a part of the portfolio that's designed for long-term growth. And so when we're thinking about long-term growth, I can't think of over the long term any other better category than having like equity type exposure or growth oriented investments. And so you kind of get these things messed up. Chaz, who's been on the radio multiple different times, the other thing that's very interesting that he talks about is diversification between investment location, meaning that you want to have the right investments in the right account, depending upon your Roth IRA or your 401k or your after-tax account. Your Roth IRA, the advantage of that account is you don't pay taxes on the growth and the profit. So if you wanted to have something that maybe had a little bit more growth potential, even that of diversification of asset location makes a ton of sense. So I think a lot of times companies and firms, they take the easy, lazy way out. And again, they just use a traditional asset allocation approach and say, hopefully more go up than down. And that to me is not using diversification in your best interest. To me, it comes down to what I was explaining when you're looking at diversification, taking that sniper shot approach of identifying in your portfolio what is the end goal and the intent that you're trying to accomplish, the time frame on when you're going to want to use it, and that can help you figure out what should be the right diversification in your portfolio.
I would take it one step further and say that people who invested in bond mutual funds over the past several years really have had a difficult time because of what you said, Nolan. When interest rates increase, the underlying bonds that support them decrease. And I found myself having more and more discussions with clients about buying individual bonds, like buying a treasury bond, buying a corporate bond where you know exactly what your yield is and you know what your risk. If it's a government bond, the government is backing the full value of the bond. But what you have to understand with buying individual bonds is that you pretty much have to keep them until maturity. But by keeping them until maturity, your interest rate has been a lot more attractive, and you've really taken the guesswork out of how much this can fluctuate. So from a diversification standpoint, how you allocate your fixed income, it really does matter. So when you look at growth versus fixed income, what is your long-term perspective? When are you going to retire? What kind of targeted rate of return do you need to have the nest egg that you're hoping for at retirement time? And that's what we will help you do here at America's Retirement Headquarters.
Help you better understand, that diversification or lack thereof in your retirement plan. Show you things that may not necessarily be tied to the market. A lot of people think that diversification is, in fact, having multiple stocks in multiple places, multiple mutual funds. You find yourself laterally stacked. So finding other ways to truly be diversified comes with a better understanding. That is what the team at America's Retirement Headquarters can help you with. All you need to do to begin the process to start that conversation is reach out right now. You can go to arhq.com. You can click on the events tab, find out about the upcoming events they've got in the next couple of weeks and register to attend one of those. Or you can give a call, set up a time to speak with them right now. Skip the line, 419-794-3030.